Welcome to another episode of Keeping It Realty with Marc and Brian. Big shout out to East Brother Beer Company, our show sponsor. Go check them out in Point Richmond. Thank you to everyone who listens and subscribes to our podcast, whether you listen to it on iTunes or iHeartRadio or Spotify, or if you watch the video cast on Facebook, YouTube. Again, thank you. The feedback is great. We run into people who view and listen to our podcast quite a bit in our normal everyday course of business, and it's very cool to get some of that
it's actually cool to get some recognition when you're just walking around the Bay Area doing your thing or going on an appointment. Didn't a tenant spot you?
I took over a 6-unit complex or 8-unit complex in Fairfield.
One of the ones we talked about in the prior episodes.
Yeah, and I'm posting notices, and I hand a notice to one of the tenants, and she comes back out and says, "You're Marc Guzman. I follow you and see you on Snapchat and see you on Instagram." And so that was very cool to run into someone who watches the show, keeps in touch, and it's awesome.
So Marc really likes his stalkers. So if you want to stalk him, he's into that.
Not really.
Okay.
Don't stalk me, please. Okay, so we're going to jump right into our first topic here. And California basically agrees in a poll done by Quinnipiac University in Connecticut that there is a housing crisis. And it's kind of funny that a university in Connecticut had to do a study of California and to basically do a poll on this. But anyway,
somebody actually got a grade point average for that.
So, based on the study, to give you very quick numbers here, there was a question of how many people can afford to live in California, and 53% said yes, they can afford to live in California. There was a question on, is there a housing crisis in California? 78% said yes. Is building low-income housing a good idea? 74% said yes. And a follow-up question to that was, is building low-income housing good in your community? 71% said yes. And then, of course, they broke that down into the difference between homeowners and renters, with homeowners saying 63 yes, 83% of renters saying yes. And, of course, there was a question, well, are the homeless people to blame for the housing crisis? And surprisingly, 17% said yes, but 59% said no. And what is the cost of housing to blame? And 59% said yes. And so, Brian, I mean, what are your thoughts on this overwhelming support to build low-income housing, yet where are we at here in California, because we're not seeing the low-income housing being built?
Well, you got to understand that even with low-income housing being built, it's built specifically against specific income brackets, right? And nowadays, $60,000 a year is actually considered low income. Not to mention that when, as a developer, you're building low income housing or workforce housing, you're still going to have to take into consideration all of the various fees, from permits to, more importantly, nowadays, there are impact fees. And, to put it in a synopsis, impact fees are essentially bribery money. In fact, it's probably cheaper to pay bribery money like you would do in other countries to get certain projects done. And I'm saying that facetiously, so don't anybody run and take me too seriously with that. But, for example, impact fees, even in low-income housing projects, can be rather significant. I mean, in a project I'm currently working on right now in El Cerrito to build 55 units by the BART station, our impact fees alone are going to be $1,152,000. And that might be a little bit higher because out of that aggregate number of $1,152,000 of impact fees, $150,000 of that is specified for public artwork. Right. So again, these are things that go from everything to expanding money for schools, which is always cool, and the infrastructure for the streets and roads to handle the additional population. But some of it is just sounds like fluff money, like spend $150,000 or donate it to the city for artwork. So all of these factors come into play when you're adding up all the costs of building this low-income housing and then how much you're going to charge each person for the rent in order to still make it feasible, right?
Well, the $150,000 expense in artwork, depending on how many years of a return you want to make on that investment you are being forced to make, can raise people's rents by $50 to $150 per month.
Correct.
And that's per unit, and that's unnecessary added expenses to the actual end consumer, which is the tenant.
Well, I mean, keep in mind, too, that the artwork is rather ambiguous. So it's almost set up in such a way where, okay, how do I go out and spend $150,000 of artwork on this building? Well, to create a big, gigantic bronze statue of myself? That would just be stupid, obviously, right?
You know what we should hang up is all the BCRE paint night photos.
That would be, yeah, that'd be great.
We just had paint night a few nights ago.
And then price it at $150,000. No, but seriously, what you end up doing is, because, I mean, where are you going to spend $150,000 in artwork, in public artwork on a 55-unit building? It ends up, you're going to be giving it to the city as donation for them to allocate towards $150,000 worth of artwork, supposedly. So, a lot of it is fluff money that the cities will charge because they do believe that the developers are making so much money. In fact, as I'm listening to some of these at the panel, one of the panelists in the city of El Cerrito even said, hey, that $150,000 you're getting off cheap, it should be closer to $250,000 or $300,000 because you're going to make so much money on this project. Right? So it's just like, hold on, you don't know any of my calculations or numbers. But all of these are factors that play into making rent more expensive.
Yeah. Okay, next topic is Prop 13. Prop 13 is being put back on the butcher block, and basically what is being looked at, which has been discussed for the last couple of years, is commercial real estate. And what they're proposing is putting on the 2020 ballot a measure that would modify Prop 13 protections for commercial properties. Essentially, Prop 13 is, in very quick terms, rent control for your property taxes. So it limits the county-wide property tax to 1%, and with a 2% yearly increase as it's assessed by the tax assessor for each county. Now, what they're looking to do is remove that protection from commercial properties and basically be able to tax them at an increased value. They're discussing They're discussing this could potentially bring in an extra $6 to $10 billion in revenue, which 40% would be earmarked for schools. There's a lot of debate on this because obviously one of the big concerns is, well, commercial buildings cover office space, it covers retail, and retail sector right now is hurting very badly. Retail sector is suffering because you have a lot of people going online to shop on Amazon. Even Walmart, Target are really pushing their online stores. And so as people are going online to buy products, buy what they need, they're not really going into the brick and mortar shops to buy those same products. Because of that, you have a lot of retail centers that are losing business, that are seeing businesses close down because they can't survive in this day and age. And now you're going to add additional property taxes to a building owner. And how is that going to be calculated? Is that going to be calculated based on the current tenants and the revenue, or are they going to calculate it based on as if it was 100% fully occupied and generating? So there's a lot of questions here too.
Well, and again, just to put things in context, this is something that very, very specifically affects me, right? I mean, and again, let's put things in context with Proposition 13. A lot of it you hear with respect to single-family homeowners, right? You bought a property 10 years ago, your property taxes don't go up substantially. And in fact, property taxes only usually go up substantially when the next person buys it, right? So example, you buy something for $100,000, your property taxes are based on $100,000 with a moderate 2% rental increase annually on that, versus somebody who bought it from you for $500,000. Now they're going to be paying property taxes based on $500,000 because it's reassessed. At that point, there's actually a realized gain of $400,000. Now, in the context of office building owners, even with no sale occurring, so there's no realized gain that actually occurred, they're just talking about increasing the property taxes regardless every 3 years for the simple fact that they believe the property went up. And the fact is that the property probably did go up in value, right? I mean, they're going to say, oh, you're going to owe more taxes on it. We're going to reassess you as though you sold it or you just bought it because your property's worth more. And the fact is it probably did go up in value because as rents are slowly creeping up, even with retail, because you got that consumer price per index that's usually attached to the price per square foot, again, and values will go up. It doesn't mean that you actually got that money in hand. You didn't actually sell the property, liquidate cash to which a taxable event could occur and to which somebody had done their calculations on the higher purchase price. It's an unrealized gain, and I'm wholeheartedly opposed to the idea. I don't know how far I'll get in opposing it because, again, you gotta keep in mind that in order to oppose laws like this, especially like with single-family protections for Prop 13, there's a lot of single-family homeowners.
Now,
not so many commercial business owners.
And another thing to keep in mind with commercial office space is that many buildings, especially the large buildings, are set up with CAM charges. Now, what these CAM charges are is where the building owner takes all their total expenses and they divide up those expenses amongst the tenants that are currently there, and the tenants pay based on a percentage of their square footage plus common area that services their square footage. So what happens is this property tax, if it increases, there's many building owners that already bill that back to the actual tenants, the businesses inside of their office suites.
And that's if they bill it back. Sometimes they don't bill it back. They're just a gross rent or a gross lease.
Yeah, and so if these property owners are billing the property taxes that are now increased back to all the tenants, well, guess what? They're going to have higher fees to pay, and some businesses may not survive.
All in all, we think it's a bad idea.
Our next topic, social media. How to do social media for real estate agents. So in the past, I've taught quite a bit of classes and I've done quite a bit of videos on how to do social media for real estate agents. One of the things, how hands-on should real estate agents be with their social media? That's a common question. For the longest time, I handled all my social media. And of course, if I had the time to do it, which lately I haven't really had much time because we've been doing a lot here at the company. But agents should be fully hands-on with their social media. And before you hire someone, learn how to do social media yourself so that way you understand how it should operate and how it should work. Brian, what would you think an agent should do?
I mean, to put things in context, the main reason an agent's going to even be involved in social media, I mean, we're talking specifically Facebook, Instagram, LinkedIn, is for advertising purposes, to make the public aware that they're out there and to call them potentially for their services, right? And again, taking it back all the way 29 years ago, I would normally spend thousands of dollars a month in print ads back in the day for advertisements in magazines selling real estate. Later, I graduated that up to online advertising through like Realtor.com, LoopNet, CoStar, or Trulia, where consumers are looking and searching for homes, and that electronic application to see or view a home comes back to us, and we're able to call them. But all these advertising forms have been changing, and now, again, I kind of stumbled on the aspect of social media accidentally, just because from what I would find just from my own personal Facebook pages, I would post bodybuilding pictures or Ninja Warrior pictures. People would chime in, they'd like, and then I get private messages saying, hey, I know you do real estate. Can I want to ask you about some deals, and then that would lead to transactions. And then as I added up these transactions that resulted from posting stupid things on Facebook, it was like 9 or 10 transactions a year. So I saw that it was pretty substantial and it was rather free. However, one thing I've seen a lot of agents do is they put only stuff about real estate in their Facebook stuff.
Big mistake.
Yeah, and I think that's a big mistake. People then see them only as a salesperson. And in fact, when I talked to one of my millennial agents about, hey, why am I getting so much stuff on personal stuff? Their reply to me was, well, you're doing it right. You're posting, pictures with you with no shirt on. And I'm like, that has nothing to do with real estate. And they're like, yes, but they're getting to know your personality. So when you're doing the social media, that's the big thing you want to do, is kind of talk about not just real estate and your services. And in fact, I'm by no means any expert at it. I've been playing around with it. You'll see different advertisements out there where they're just straight up goofy that we've been doing, to very intellectual discussions like we're trying to do here.
Yeah,
and all that's to showcase your personality, and that's important.
And I've come across some people that say, well, I don't want to showcase my personal side. I want to keep personal and business sides separate. And there are ways to advertise your business on a day-to-day basis without spamming people or making it look like every other real estate agent.
And I think that itself is a mistake. You know, in fact,
just advertising business? Yeah.
Well, just advertising business or keeping things separate. In fact, I tell my agents all the time who come in and we're talking about their spheres of influence, because what they'll typically do is they'll have an email for business and an email for friends, and then they'll have contacts for friends and a contact for business and contacts for church. And the fact of the matter is that all of that should be lumped into a big, gigantic contact pile with just key tags to that individual as to what they could be. Because the fact of the matter is your ex-girlfriend can become a potential client or ex-boyfriend or whatnot, or church member, or, you know, past client, or even past enemies, right? Become clients.
So that's the ideal way to do it. However, there are a lot of people that simply want to keep it separate. So there are proper ways to just advertise your business side of things on social media. One of the easiest and best ways to do it is to create how-to videos. There's a lot of Instagram pages, YouTube pages, Facebook pages that are very successful, started by individual, single, self-employed business owners that will create how-to videos. And they've become very popular and get a lot of business by creating these how-to videos. And one of the big mistakes I've seen agents make is they post about their open house. They post about their new listing. They post that their listing just went pending.
And that's very canned and pending. Very canned.
That is so overplayed and so stale, because guess what? 98% of all agents on social media are doing the exact same thing.
That's almost as overplayed as the housing crisis.
Yeah, right. So my tip is, if you're looking to succeed on social media, make a list of as many agents in your area that you can find on social media. Look at their pages, look at what they're doing. I guarantee you're going to find the same common trend amongst everyone, and you need to figure out something different. Okay, next topic is real estate myths. So myths about common or commercial real estate and property management. So there was an Inman article, and I'm gonna basically pick a few here. And Brian, feel free to chip in on your opinion here. But myth number one: making big income is very easy with little work and time involved.
Yeah, that's
basically passive income.
Huge myth. That's a lie.
So one of the big issues in today's world is that, going back to social media, it's so easy to sell on social media. In fact, there are 18 and 19-year-olds that are making $100,000 to $200,000 per year selling programs on how to do passive income. Guess what? They're making passive income off of the work that they're putting in to sell you a crappy program.
Yeah, well, it's not too different from real estate, from those real estate seminars that teach you how to be a successful real estate agent, and that individual is making money from selling you seminars on how to become a successful real estate agent, but they're probably not practicing sales themselves. They did for like 2 years, and they
went from infomercials to YouTube.
Yeah.
And, as much as like the buy referral programs, the Tom Ferry programs, and as much as those have good information, get you riled up, the majority of those agents probably lose money every year based on the coaching and based on the actual products that they buy compared to the actual sales that they make. Right. But it gets everyone feeling good and riled up. So you got to put in work. You got to put in time. Depending on what your goals are with property. Here's a good example. If you're going to buy rental properties and manage it yourself, guess what? There's a lot to do in property management. That's a full-time job in itself. You're not going to be able to automate it and just let it sit off to the side. If you want to automate it, what you need to do is hire a property manager. That's the first step. But even if you hire a property manager, that manager is going to be coming back to you for decision after decision after decision, and you're going to be managing it and still putting in some work into it. If you really want to be 100% passive, that's where you hire a asset manager to then manage the property management.
Just to kind of interject there, anytime you're getting involved in anything entrepreneurial, you're going to have a lot of work. So one of the first things you should always do is kind of do something you love, right? Because honestly, if it's something you enjoy doing, then the hours that it takes going into it really go by rather quickly, as opposed to something you just trying to do because you think you're going to make a ton of money at it because you're following some myth. And which is like a big common mistake, that you're going to just make all this money having a real estate license with little to no work, because that's just because real estate agents just make money for doing nothing, right? Like that's just a big myth.
Here's another myth. The hours you put in will be less than a regular job.
Yeah.
I literally work anywhere from 14 to 16 hours a day, 6 to 7 days a week consistently.
I mean, like I came in on a Sunday and I saw you working, because I was coming in on a Sunday, and I've been doing this 29 years, right? So,
and I'm not gonna lie. There's sometimes I see people that work 9 to 5, and I'm not gonna lie. Sometimes I'm like, man, that'd be a nice schedule to have.
Right.
I can do real estate part time. You, as a broker overseeing agents, you obviously have agents that try to do it part time.
Yeah.
How does that compare to agents that do it full time?
Well, again, I don't even really take on agents anymore that want to do it part time. I have some people who've been with me for years who've been part time, and again, like we've talked about this, and we talked about this in other episodes where, some offices have agents who really just sell one transaction a year, and you barely ever see them, and you can't do real estate these days part time. And that's if you're going to work a 9 to 5 job and then you're going to come in the evenings. And the way that social media, the way that the internet, the way that cell phones have connected everybody these days, people want instantaneous gratification. They want instantaneous response. And nowadays, with the internet providing so much access to properties and consumers being able to access them, your job as an agent is to really be the expert, from the legal to the finance, and be able to guide them through the process, and that's your value add, and you can't do that part-time. So that's a huge myth. In fact, every time I've seen people just put part-time hours into it, they're very dissatisfied, and I'm very dissatisfied.
Yeah, I mean, one thing, and it seems like I've been having so many conversations with people in the last couple months of people wanting to get their real estate license to help people buy and sell properties.
Well, keep in mind that a lot of times people do that because they'll look at somebody who is successful and go, I want to be just like you.
Correct. And the conversation I have with them is, really make sure this is something you want to do and try. Maybe get a part-time assistant job with a real estate agent that's successful. Get to know the business a little bit more, because many people don't realize that the average real estate agent makes $39,000 in gross commission income per year. Minus expenses, take home is in the $20,000, like $28,000 after taxes.
Right.
So it's not as much money as people think. I mean, that's the average. 65% of all agents have made one or less transaction in 2019. One or less.
Yeah.
The majority is zero.
Now, keep in mind, the amount of money you can make is rather unlimited, but
Correct.
you're going to pay for that in time and experience. And the only way you get experience is time.
And it's not really unlimited, too, because you have a finite number of transactions that happen.
Right.
And the more and more agents that come into the business, the less and less everyone shares.
Clarification. If all you're doing is only selling houses, then yes, there is a certain number. But even then, I've seen agents out there who close 300 transactions a year in teams, and so they're clocking in really large dollar amounts, right? So it is possible. It's just you have to diversify or really spend a lot of time.
Now I'm just going to throw this in before we get to our feature topic. But if someone is really interested in getting the real estate license, feel free to reach out to any of us. So, I mean, we'd be more than happy to talk to you about property management or sales side of the business and guide you as to maybe you want to find out if this is really something you want to do. Okay, our feature topic today is fighting the recession by manipulating the market. There's a lot of discussion about market manipulation because of our current president right now, who has been, Sam, how many tweets are we at total with about the Fed with the Trump?
65.
So 65 tweets since he became president.
12 in the last week.
12 in the last week about the Fed, about rate cuts, and there's a discussion at what point is he really trying to influence the Fed in order to reduce the market rates? And this kind of sparked some questions.
And
What
keep in mind-
is market manipulation, and what really happens?
What we're speaking about specifically in the general context of market manipulation is Trump's tweets really affecting the feds in the decisions that they make? So that's kind of what we're talking about here.
My short answer is no. His tweets are not really affecting the Fed and their decision. However, it does affect some of the trading volume that happens, because the majority of trading, something like 98% of all trading out there, is done in microseconds by all these trading firms. So their algorithms pick up all the news, pick up all the data, and will calculate what trades need to happen. And these trades are done in microseconds. In fact, there's new technology that is being reviewed by the SEC that, if allowed, they'll be able to make transactions in like 0.0015 seconds, which is crazy, crazy fast. Instantaneous.
Robo trading.
It is, yeah. Now, going to market manipulation, that may sound as if it's really bad, because we're in a we all tend to believe we're in a free market, capitalistic free market. But there is a lot of market manipulation that already happens. In fact, that's what the Fed does. That's their entire job. If you just let a market, a capitalistic market, just go out on its own, there will be recessions, there will be booms, there will be a lot of things that happen. However, that's where the Fed comes into play, because the Fed will actually manipulate the short-term rate
For
in
example,
order to,
they'll drop rates to stimulate the economy.
or they'll increase it to
Slow it
down, which is exactly what they began to do back in 2018. And when in 2018 in December, when they hit 2.5% rate, it caused a big surge, because as great of an economy we've had, there are a lot of indicators that show that the economy is not as good as people think it is.
And it's slowing down.
Well, lately, one of the issues happening is the China-U.S. trade war. This has been affecting a lot of people outside of China and U.S. I mean, you have China and U.S. fighting together for the market share of global business, and this is really what sparked the U.S.-China trade war. Now, China and U.S. are trying to stay and compete as number one superpower in the market share, but what people don't realize is that every country does business with the U.S. and China, and now you have countries like Germany starting to experience a recession because of this China-U.S. trade war.
Exactly. It is kind of strange. And keep in mind, just to put things in context again, China makes things and they import them over here and we buy them. We have an unfair balance where we have more goods coming in, and so what Trump's trying to do is simply make the cost of those goods more expensive, so people buy less, and people are going to tend to buy more American-made products, right? Hopefully to put some kind of pressure on China to make the balance of trade more equitable. But China can turn around and just very easily reduce the amount of their currency, and then they do what's currency
Which is what they did a
right?
month ago.
Yeah, and in fact, several years ago, one of the things that went on was that China pegged their yuan at, I think, $7 yuan per dollar, right? And they agreed not to let that go down, because keep in mind the effect of devaluing the yuan. That just makes it so much more cheaper to manufacture in China that it becomes cost ineffective to do things in the U.S. So now, whereas they agreed not to reduce or devaluate their yuan, they're going the opposite direction in response to the tariffs that we're imposing on Chinese goods. And it's just this back and forth battle, essentially competing for our consumer dollars to buy products. And this is what we're beginning to see, slowing down the rest of the economy. And then now the Fed is trying to react to it by potentially lowering down rates. In fact, you see that in Trump's tweets all the time about adding pressure to the Feds to lower rates, because what he believes, it's like that old Reaganomics or trickle-down economics, where if you put more hands put more money in people's hands, they'll tend to buy more products. They should offset any of the expenses that are incurred by the tariffs we put on imported goods. Not to mention that if you're a business owner and you have more access to cheap capital, then you will create more jobs. More jobs will put more money in people's hands, and they can buy more product and continue to fight the war against China and their unfair trade imbalance.
Now, one of the reasons why the Fed wanted to increase rates back in 2018 is to ward off hyperinflation. That was one of the concerns back in 2017, and one of the small reasons why they wanted to push the rates higher in 2018. The big reason, though, is we've gone through from the bottom of the 2008 the Great Recession. We've had a really long stretch of a booming market here in the U.S. And one of the reasons why the Fed wanted to increase rates is because when we hit that next recession, they then have room to lower rates in order to stimulate the economy. The problem now is if they're going back to reducing rates from 2.5% to 2.2%, there's talks about even getting back to 1.5%. If they go back down, then when we actually hit the next recession, there's not going to be enough room to actually work your way down.
What country was that you were referring to where they're actually doing a negative rate?
There's a Dutch lender that just came out and did the first negative 0.5% rate for a 10-year mortgage.
So they're actually paying you to borrow money from them.
They're going to collect less money at the end of the 10 years than what they're actually going to loan to you, and they know it, and that's the way the numbers work, and they're okay with it because they don't feel comfortable in investing that money elsewhere in a global economy because they are predicting a global economy slowdown to where losing 0.5%, that's a good deal.
In fact, I think that it's mainly for portfolio lending for homes in their area where they will service the loan for the life of it, and they can anticipate they'll lose less money if they just keep the money in-house or in country as opposed to investing it abroad.
Yeah. And it's very interesting, too, because you have JP Morgan Chase and Pacific Investment Wealth Management. These are two big companies that handle a lot of business globally. They came out, and one of their concerns is that if there's a global slowdown in the market, that this could put downward pressure on the U.S. This, between the China-U.S. trade war plus a global slowdown in the economy, could potentially throw that short-term rate down to zero, and we may even see negative rates here in the U.S. Big
That'll
prediction
be
by JP
interesting.
Morgan.
I mean, it'll probably spawn a big refinance boom again, but if that happens.
Yeah, if that happens. But again, you're not going to be able to refinance if your company's had to lay you off.
Right. If you don't have a job at that time, then it'll be hard to refinance. But if you do have a job and the rates do drop down to 2% or negative, then it would be a great time to refinance.
Yeah. So
as morbid as that sounds.
So one of the questions we get is, why are we focusing so much on global trends? Why are we focusing so much on a national economy? And how does that pertain to real estate and properties we manage?
We're a global economy now. And so what happens in the U.S. or what happens in the rest of the world does affect our local real estate markets. I mean, even with China, even though they're as prosperous as they are, there's still people who move money out of China and buy in the U.S., even though that's slowed down tremendously from what it did in the past. You are still seeing a lot of Chinese investors who are doing very well in China and can continue to do very well, just diversify their funds and invest in U.S. real estate still.
Well, there's also a big group of Chinese investors that simply invest in real estate here in the U.S. because they're simply moving money back and forth, assets back and forth between China, and they're really trading the currency, not so much real estate.
Right. Well, those are currency traders, and that's a very small, finite demographic of people who could actually do that.
But it's a big chunk of commercial Chinese investors.
Sure. It's currency trading.
Yeah, exactly. So that's one aspect of it. But then how does it affect your own rental properties? Well, if a global economy puts pressure on companies to lay off people, to close up shop, well, that could potentially affect your own tenants that would be employed by those companies. And if your tenants are having layoffs, you're going to end up with evictions. You're going to end up with much more vacancies. And that's where, it has a big effect. And that's where we track all these different trends, because we're able to then try to mitigate a lot of this risk early on, as opposed to reactionary tactics where something already happened and now we're trying to fix a problem, whereas we can fix it ahead of time. Try to lock people in at lower rents, or maybe we don't increase rents. That would then encourage people to leave. We keep rents the same but lock them in longer. There's a lot of different tactics that one strategy we have this year may change next year based on market conditions.
Yeah, it's just being able to understand what's happening downwind and adjust accordingly to it months before in anticipation of something going wrong.
Yep. So if anyone has any questions, wants to reach out to Brian or myself regarding commercial sales, home sales, or property management, feel free to contact us. Thank you for listening to the podcast. Make sure, if you haven't already, subscribe to iTunes, iHeartRadio, or Spotify, and make sure to subscribe on Facebook, YouTube to watch the actual video cast.
Yeah, and again, thanks for tuning in, and please like and subscribe.
And thank you to East Brother Beer for being the show's sponsor, and we'll catch you on the next episode.